Hello everyone, it's Ari here. I wanted to share my thoughts on a new company with you guys. This company is called Cumulus, and it's a radio uh, company, so it owns a bunch of radio stations throughout the United States. You may have heard of them in your local community. I was in Houston recently, and I think 141.5 or something FM, and they said we're a Cumulus station. So this company is in trouble. We can see, looking at their stock chart, on a long-term stock chart, this company is at the lowest really it's ever been. And I wanted to go through my thoughts on whether or not it's a good company to invest in, and my conclusion is that it's not a value investment, but it may be an interesting speculative investment. But if I had it in my portfolio, I'd make it a very, very small position. And I'll tell you what's in favor of Cumulus, but what's out of favor for Cumulus. So obviously they're at the lowest price they've ever been, and I'll discuss why that is. But first, let's quickly look at the business. So this company is a provider of country music and lifestyle content through the Nash brand. So they're big in country music world, and they also, in addition to country music, they have other radio stations. So the one in Houston was a pop and R&B station. They make money primarily from advertising. So you can see broadcast advertising, digital advertising, you can see your political advertising fees. So what's going to be big for this company in the next couple of months is the political advertising as we move into the election cycle. And that could provide a boost because those are higher margin advertising slots. What governs the amount of advertising revenue is, one, overall spending on advertising by companies, so the health of companies, which is fairly good right now, but also the ranking of the radio station. So the higher the station is ranked in that local market, then the more the advertisers are willing to spend on advertising on that radio station. And the problem for this company was many, but because of a variety of things, their ratings have slipped recently, and they started moving down the ranking list, and because of that, their revenues were hit. So I like to always look at the financials of any company I consider investing in, and you can see how the blue bars, I'm looking on Google Finance, which is available to everyone. You go to income statement, I made it annual. You can see that revenues were generally increasing, and they had a profit margin that was positive, which is the red line, for the past couple of years. But in 2015, you can see that there was a slight dip in the revenue. And if we look quarterly, it seems like we're not doing any better. So it looks like the first quarter last year is about the same as this year. And it looks like they took a big write-down in the third quarter. And we can see that here, unusual expense. So they took a major write-down in the third quarter because their radio stations were losing rank, and the advertising revenues were declining as a result. Now, because the company is in distress, I like to look at the balance sheet and the cash flow statement, because this tells me more about the liquidity for this company and whether it will be able to survive the distress. So looking at the quarterly balance sheet, the latest balance sheet we have says that they have about $60 million in cash, and they have about $356 million in current assets. So current assets, for those of you who are unfamiliar with the term, are assets that are expected to be converted to cash within 1 year. And their current liabilities are 130. So current liabilities are liabilities you're expected to pay within 1 year. So you can see just off in the back of the envelope that they seem to have enough current assets to meet their current liabilities. So they seem to be liquid from this measure. Now, they don't have much inventory because they are not a manufacturing company, they are a radio company. They have a good amount of receivables. I mean, so their payables are quite small and have been small, and the receivables are quite large. So the payables are money they owe other people. So they don't really owe other people money, and they seem to be collecting money on credit. But you can see how the receivables are, relative to the first quarter last year, they're slightly down. What's a couple of things that are worrisome from this balance sheet analysis. One is that if we go to the debt section, you can see that they have $2.4 billion of long-term debt. And they don't show any of that as current. So another thing that's public to everyone, but a little harder to navigate, is the SEC's site. So if I Google SEC Edgar and click on the first link, then I get taken to this page, and if I type in the symbol for the company, which is Cumulus, CMLS, and hit search, then I get a list of all of their filings. And so what we're looking at is the latest quarterly filing. So I can click on the 10Q here, and then I can click on the link to the 10Q. So this gives us a more detailed, perhaps. Sometimes Google Finance doesn't pull everything into their analysis. So let's look. So they have, I just want to make sure they don't have short-term live. So it doesn't look like they have any current debt due in the next year. So let's look. They have long-term debt of $1.8 billion, which has a 7.75% interest rate, which is something to think about. And they also have senior notes. Oh, excluding senior notes. So they have long-term debt, excluding the senior notes, of 1.8, and then they have 600 million of senior notes at 7.75%. So that's quite a heavy debt load, because if we look at the, we can look at the book value of the equity here, which is only $2.4 million. So relative to the assets on the balance sheet, the debt is pretty much everything. So remember, the equity is one claim to the company's assets. The debt holders have the other claim to the company assets. Here it looks like the equity claim to the company is only worth about $2.4 million on a book basis. So let's look at the assets. So we talked about our current assets, but the main assets here seem to be goodwill, which is $700 million of goodwill, and $160 million of other intangibles, which could be the relationships they have, and so forth, the brand that they have. But I don't really know of many people talking about Cumulus as a brand. I guess the Nash brand has quite a lot of value potentially, but a lot of this assets are not real assets. They're intangible, they're brand related, and if we add these two, there's about $860 million worth of intangible assets, and the stock claim is only 2.4 million on as is. And I always like to really eliminate the intangible claims, because it's hard to achieve those in the event of a bankruptcy. If you're going to liquidate this company, very unlikely that you're going to get anything for goodwill or intangible assets. You would need a company to come and buy the company ahead of bankruptcy in order to cash in on this. So taking this out the 860 million of intangible assets, then you're already looking at a very substantial negative equity value. Now, the broadcast licenses are worth something, but 1.6 billion of licensing assets is not even as much as the debt by any stretch of the imagination. So, and they don't have a lot of property, so this is mostly about licensing. So it looks like the equity holders don't really have a solid claim to any value in this business, especially so they have a claim to any potential growth. The problem for this business is that it's distressed, so the growth or upside potential could be truncated, because if they default or declare bankruptcy, the equity likely will get entirely wiped out. So I like to look in the 10Q, let's look up more information on this debt. So I'm going to look at, I just do a Control F and I look through for the debt section. So long-term debt. So I get here and they tell me more about the debt. So we have a term loan, and then we have the 600 of senior debt. Now let's see. So the term loan bore interest at 4.25% per annum. That's not too high of an interest rate. And I'll show you that they seem to be able to cover interest with their current cash flows. And when is the maturing in December? So the credit agreement consists of a $2 billion term loan maturing December 2020 and a $200 million facility maturing in 2018. So they have a 2 and up to 30 million. So they have $2 billion of debt that's due in 2020, end of 2020. And then what about the notes? So if we go down to the notes, they have 600 million of notes at 7.75%, and they're due in 2019. So come 2019, this company owes $610 million of notes, and then 1 year later, end of 2020, they owe $2 billion, and this is going to be a big part of the distress. So the company's rankings are low, their cash flows are low because of the advertising fees they can charge are low, and right now it's mid 2016. In a couple of years, they're going to face some major debt repayments. And in order to refinance this debt, they're going to have a strong enough operating business in order to convince anyone to refinance the debt, which means they'll replace the debt with new debt. So let's go back to the Google Finance. So you can see overall their leverage is quite high, and remember, a lot of these assets are intangible, so I would say their leverage is probably above 100% here on a book basis. And just quickly, you can see that their market cap is $72 million, which relative to the size of their debt burden is nothing. So really, this company has no equity value. The only reason the equity has any value is because of optionality. So if the business improves, then eventually the debt will be fully recovered. Right now, the debt probably wouldn't receive 100% recovery in a bankruptcy situation. But as long as the equity holders have claim to the company, then with enough time, there's always a chance that the company improves, and then the debt holders would get 100% recovery, and then whatever's left is for the equity holders. So it's trading as an option. Now, if we look at the cash flow statement, you can see that this business is throwing off cash. So cash flow from operations, that is the money that the business is making or the assets are producing. It covers interest expense. So in this figure is the interest expense. So we are accounting for the fact that they have $2+ billion of debt. So what this tells you is that they seem to be able to service the interest expense, at least in this first quarter. Looking last year, they were able to service it, they were able to service it, they were able to service it. So this is a cumulative figure, so it's this plus whatever is new, plus whatever is new. But you can see here from 88 to 82, that's a decline, which means that they didn't produce enough cash in that quarter, the last quarter of 2015, to really cover the interest expense. So they seem to be throwing off enough cash to produce the interest. Let's see. When are the payments due? Semi-annual or quarterly? Okay, well I don't. So you may want to look at when the actual cash outflows are. But anyways, they seem to be sort of on the verge. They can pay the interest, but there's no way they're making enough cash right now to be able to pay the debt if the debt became due. And so the next question then is, what might trigger a bankruptcy? So then I would look at covenants. So we're looking at the credit agreement. So this has the credit agreement is a $2 billion term loan, and then this facility, which is like a credit card for the company. So if we go down a little bit in that section, the representation covenants and events of default are customary for this kind of transaction. So the failure to pay obligations when they're due is obviously a problem. The failure to comply with certain covenants, certain defaults and accelerations under other indebtedness. So if there's other defaults, then this is cross-linked. So if they default on one piece of debt, everything becomes due. So if they suddenly have their broadcast licenses suspended for whatever reason, that would constitute or trigger a default. Okay. So if they borrow under the credit card, then they also have to comply with some leverage ratios. So the first lien leverage ratio covenant. So this is the first number. The required ratio is 5:1, and the first lien net leverage ratio periodically decreases until it reaches 4:1. It has no borrowings under this facility, so it's not required to comply with this ratio, so we can ignore. So they have no borrowings on their credit cards, so they don't have to worry about this covenant. Okay, just looking through. So didn't really give us too much detail on the covenant. So the 10Q is not always a great, doesn't always have as much information as the 10K, which is the annual report. So let's just take a quick look. Let's look at the long-term debt section here. Okay. So this looks like the same language. Same language. Same language. So I'm not seeing any. So before you make any substantial investment, you really want to look at the covenants, because the covenants are what are going to push this company into bankruptcy. It looks like they have covenants if they use their credit card, which they're not using, the credit facility. But otherwise, it says that their covenants seem to be quite customary. And so I'm not seeing, so what I'm looking for is if they have any performance covenant, which is usually they have to have a certain amount of profitability relative to like their interest expense. So they need to have enough cash relative to cover their interest expense by a healthy margin. I'm not seeing that. I'll put it in the comments below the video if I do see that at some point. But so, big picture, this company has fallen so hard because their rankings have slipped, their cash flows are at risk, and they're producing enough to cover their interest expense so far as we can see, but they really need to turn around the business, and they really need to restructure the company so that it has a chance to improve the cash flows. Now, one thing I like to look at always is insider purchasing. So I want to see what the managers think about the stock. And so I like to look at openinsider.com, and if I type in CMLS for Cumulus, we can see that there has been some purchases. So even at 22 cents, which is lower than the current price even, Crestview Radio investors bought 2.5 million shares for $550,000. And it looks like they've been purchasing on a pretty regular basis. So this was November 25th of last year. And then you can see that June 1st of last year, they purchased another 550,000. And then May, so a few days before that, they purchased 500,000, 600,000. And a few days before that, they purchased 300,000. So they were aggressively buying the stock in May. And then again in November after the fall. And they own 65 million shares. So if we go here, we can see that the share count for this company is 233. So if we take, let's say 65 divided by 233, they own about 28% of the company. So you have investors who are quite incentivized to turn this company around, and would potentially lose quite a bit, because a controlling stake in a company is worth a lot as well, and that's at risk if they lose. But who are Crestview Radio investors? Let's see if we can see. Crestview Partners. Let's just double check something. Crestview Partners. Yeah, so Crestview Partners announces formation of Cumulus Radio investors. So these guys are the people. Let's look at their firm. So what I'm wanting to see is how big this firm is. Does this stock even matter for them anymore? So capital commitments of $7 billion a year founded. So they're a multi-billion-dollar fund, and right now they have a position in Cumulus. They have 65 million shares, and say the stock's at 32 cents. So they have about they have about $21 million worth of the stock, which is reasonable, but relative to a $7 billion fund, they may just throw up their hands and walk away. Let's see how many investments they have. So here they put Cumulus Media, current portfolio. So you can see a sort by status. So these are all realized investments. These are investments they've made and sold. And then you can see there's quite a lot of current investments. So Cumulus Media is only one of many. And the reason why I was looking at the stock is because I saw that it was quite cheap and going through, obviously a bad period, and I saw that there was an active person buying the stock at least since May of last year. So if we look at May of last year, we were around this price. So most of their buying was before whatever happened here, but they did buy again at 22 cents. So they have the best information set, better than any of us can ever aspire to, and it does look good that they are willing to invest. But this is definitely not a value investment, even though it's so cheap as a stock price. It's not trading below tangible book value. Remember, tangible book value is quite negative. So this is definitely a speculative investment. But if we, so what I then will do is I'll look and try to understand what the business is doing to perhaps right this situation and get out of the distress. So I like to go to Seeking Alpha to see the company's transcripts. So I want to hear what the CEO is saying about this company. So if I look at this, if I type in CMLS and Seeking Alpha, and then I go to the transcripts tab, I can see the transcript, and then I always make it a single page. So I've read a couple of these transcripts already, and I suggest you always do this. What the business assets are, or how they're performing, or what the future looks like, unless you read what the managers are saying. So we have on the call Mary Berner, who's the president and CEO. Just a little background on her is that the previous CEO actually left the firm, and she's now been on board for a couple of months, but she's relatively new to the company, and she's been figuring it out. She's been going around the country to meet with the various stations and the various providers of content, and she seems like a pretty good CEO. So I was also attracted to this company because I thought what she was saying was quite admirable. For example, she said she sold the company airplane. They had one or more company airplanes, and they sold the plane and used the money from the sale to pay down the debt, which obviously it doesn't really pay down much of the debt. They have $2+ billion of debt, but it's more of a signal. So she took the plane and sold it, and again put the proceeds towards paying down the debt. And then she said that the interest expense that they saved on that debt, so if they cut $10 million of debt, for example, then they don't have to pay the interest on $10 million of debt. But she said that interest savings was reallocated towards an employee improvement program. So they have now programs to provide training and development courses to the employees, and what that's served two purposes. One, it's a signal that the CEO is not about empire building or about wasting capital. She's very focused on making sure that everyone knows from the top to the bottom that they're trying to save cash. And also it serves another purpose, which is that she pointed out in previous calls that this company had very high turnover. So a lot of people would come and leave, and they never really liked working at this company. And part of the reason is that there are a couple of reasons, but one of the reasons was there was no real investment by the company in development of the employees. So she was accomplishing that meeting that problem by setting up some programs for employees and funding that by selling the airplane. So it's a very symbolic move by the CEO. I think it was very admirable. And she's also done a couple of other things to restructure the company and make it more nimble. And I think a couple of those moves were good. One obvious thing she did that was good was she required there to be a certain, I think it was 24 or maybe 48-hour, 72-hour turnaround for emails. So supposedly beforehand, people would email questions and to make decisions that were important for the business, but there would be no response in any reasonable amount of time. And in order to move the business forward and act quickly, she instituted a policy that you have to respond to emails in a rather short amount of time. She also did something which was, instead of people being incentivized by just the profits of their individual division, they're incentivized now more by the profits of the overall company. And the reason that's important is because when you when you have these various platforms all over the country, you may benefit actually by playing advertising, for example, from some other station that they have secured, uh, and playing less advertising in your local market. But in order to accomplish that sharing of advertising dollars, you have to have your incentives correct. And so she made the incentives more collaborative, which I thought was good. So overall, reading what she said, I thought she's quite an articulate woman, and she has some pretty good strategic goals. And she seems like the right person to turn this company around. But I'm a little, again, this company is not a value investment. It's definitely a speculative company, and the main reason is that there's no value for the equity holders other than this intangible value. And the company has, in 2019 and 2020, some very big debt obligations coming due. And it's not buying. You're not buying 10 cents or buying $1 for 30 cents. This is definitely speculative. But if we look at the stock price long term, it was down at 50 cents in July of 2009 and in November of 2008. Probably in both cases because, as you can imagine, customer demand gets hit with a financial crisis, and also advertising dollars get cut aggressively as companies try to save cash flows in order to service their debts. And it bounced back very quickly. So it has been at this level before and come back. But do we know when these guys made this investment? Let's see. So it doesn't tell us when they made this investment. I wonder if they owned it back then. So it's been this low before, but what worries me is that it's been this low and stayed this low now for a little over over 6 months, 7 months. And if something is low for a long period of time, it's probably not cheap. It's probably correctly valued and low. I mean, a lot of people are looking at this stock, including these major owners, and notice they haven't bought anything since this year. So I think this is a very risky company. I think I did this in order to walk through an analysis for you guys, but I think of a company that you should probably avoid. If anything, you should put a tiny fraction. I'm talking maybe 0.5% of your portfolio in this company, but it's really not worth. The exercise is looking through a company that looks cheap, but then realizing the pitfalls that will probably compromise any returns that you could have hoped for. So I'll update you if I see any changes, but I think that this company is a no-go, and that's my analysis. If you have any questions, please leave them in the comments below, and remember to subscribe, and I'll keep posting my thoughts on various companies, and I'm hoping that through my discussions you guys learn something about looking at stocks. I've been doing it for a long time, and also I'll learn from you guys. So if you have feedback, please post it below, and I'm always happy to discuss companies even by email if you want to. Okay, thank you guys. Bye.